Morning, Kerrod. Welcome back to Your Wealth Playbook. Huge news overnight out of the US. The Federal Reserve has cut rates with markets already at all-time highs. Today, we're going to talk about why this should scare the absolute shit out of you if you don't own assets.
Now, if you do own assets, this is probably going to be the best news that you're going to hear. But if you don't, and you're still on wages, we're going to explain why, even though that the Fed is in the US, why this affects you and how this is going to be so detrimental for you long term. All right, let's cut straight into it. The Fed have just cut interest rates for the first time in 30 years when markets are at all-time highs. S&P 500, which is the US market, the Aussie market here, the ASX 200 or 300 or whatever you want to look at, is at all-time highs. Property valuations around the world are at all-time highs. But inflation is still sticky. It's at 3% and they're cutting rates.
Now, the reality of when the Fed cut rates is that they make money cheaper. They make borrowing easier. Holding costs of assets, be that shares or property, comes down because you're paying less out in interest. Now, people who already own stocks, people who already own property and businesses out of this decision are going to get richer faster.
It's a bit like paddling down a stream when you're building wealth. You're going along nicely, everything's all fine and dandy, but what the Fed's just done for you and for your wealth building is they've just thrown a motor on the back of your canoe. Now you're going quicker. Going down that stream a hell of a lot faster. Money's now cheaper for you, valuations rise, stocks rise, properties rise, and Jared, when markets are near all-time highs, 12 months after, the historical data says that markets are up around 14%, or the S&P 500, which is the largest market in the US, is up 14% 1 year later after they cut rates. Geez, that's a cracking return. It differs, yes, if you go into a recession or not. But Jared, why has the Federal Reserve just cut rates when inflation is at, still 3%, not under their mandate?
Well, all the news that we get within Australia is about inflation. Keep track of inflation. Inflation's running way too hot post-COVID, and we needed to get it down. The only way we could do that was by increasing rates to subdue what was happening with inflation. That's all that we're fed there. Now, the US has a dual mandate. When it comes to this, there is the numbers that come out with inflation, which, like you said, is still running hot, over 3%. Within Australia, 2 to 3% is the bandwidth that we want to stay within. But there is also unemployment numbers that have come out of the US.
So unemployment numbers, they've got the dual mandate in the US. So they've got inflation, plus they've also got unemployment, or basically how well the economy is stacking up. So inflation, yes, is still too hot, which is why they've kept interest rates on hold all year. The last cut was actually back in October last year, September, October last year, just before the election. But they haven't cut any rates for the last 12 months. We've just got some staggering news out of the US that they've revised down the total jobs that were created over the last 12 months by 1.5 million jobs. So therefore, the unemployment rate is starting to tick up. This is making the Fed nervous, and they've cut interest rates. They've got that dual mandate there, as you spoke about, and with that revised jobs data, they have cut interest rates.
Now, this revised data is not underemployment, which is also reported, where people have roles that are casual or part-time and they don't have enough hours within that role, so they may need a second role. This is actually unemployment data that's come out that's been revised. Jobs
gone. Yeah, 1.5 million less jobs over that following 12 months.
How does that happen?
Oh, who knows these days? Someone has, I don't think that that's just a slight little error or one little zero that they've missed when they're reporting this data. I've seen that Trump, love him or hate him, he actually fired the head of the statistics over there 2 months ago about the revised data that was getting, misled or misleading. And the Fed's chair, Jerome Powell, has always been that he's stated that we're data dependent. So if he's relying on these numbers and they're wrong for the last 12 months, how long ago should he have been cutting rates? Because we have seen now 12 months no rate cuts, but that data's just been revised for 12 months. So as a matter of fact, he probably should have been cutting rates a hell of a long time ago.
It's going to have a huge impact on what is already a widening gap between rich and poor, with policy now coming through due to mistakes in data. And like you said, potentially 12 to 18 months worth of cuts not being seen for the average household that needs it.
Yeah. Well, Jared, what we're talking about the Fed today is the Fed's the big daddy in the world. They hold the key to everybody. The US, as we know, is the global reserve currency. So when they're making their money cheaper around the world, it has a flow-on effect everywhere. Because now our money here in Australia, because our big banks go to the US to go and get money so that they can lend, their money becomes cheaper that they've got. So the US is so important for everybody around the world, and the economic expansion, especially when they drop their rates. And that is going to have a flow-on effect. And you just spoke about it, the wealth gap. If you don't own assets, now, Jesus Christ, you're going to get left behind, because everybody's feeling the pinch, especially over these last 5 years, Jared. If you hadn't owned assets, the real wages in Australia have come back, since COVID. Everything is more expensive. I'm not sure if you've gone and got bread and milk lately, but Jesus Christ, everybody is starting to feel the pinch. And if you're just on wages, you're going to continue to feel the pinch.
Now, this is not a solicitation to go out and buy assets. And when we're talking about assets, we're talking about shares and property. This is general advice when it comes to this topic. But in terms of what we're talking about here, you have a look at the price of a property 5 years ago. You have a look at the price of, like you said, the S&P 500, the ASX 200 5 years ago, and where it's currently sitting now. By having that cash sitting in a bank account, it's not going to be doing anywhere near what you would experienced holding assets of that nature. Now, in terms of going out and just buying assets now for the sake of buying assets, you still need to be strategic in the decisions that you're making. But the difference between owning an asset now, before the flow-on effect of this for 12 months, 18 months, like you rightly pointed out, if we're even in recession markets, we're seeing 14% increases in the S&P 500. If we avoid recession at this rate, we could see 20% plus, which is what's the average over reporting history we're seeing.
Yeah, 20% over 12 months if we don't go in a recession, which is what the Federal Reserve is trying to do. They're trying to lower that unemployment rate because they don't want to see it tick up, which means that we're going to head into a recession. So, but Jared, talk to me, why is it that asset prices go up when money becomes cheaper?
So when money becomes cheaper, your cost of holding a property goes down. Your yield that you're looking at, your net yield, goes up because you have a fixed income. Let's say it's a property where you're getting $800 a week in rent. That $800 a week stays as is. When money becomes cheaper, your cost of holding that property comes down. So that then enables you to generate a higher net yield for that asset that you own.
Does your borrowing capacity increase if interest rates are lower, Jared, as well?
Yep, absolutely.
So if your borrowing capacity increases, plus the holding costs become cheaper, does this flow into people overpay or pay a little bit more for property in Australia?
Yeah, at that point in time, whether it is shares or property, people will see the future of that asset and the income they can potentially earn on it and the yield being more attractive than what it would have been in a bank. And you can see at the moment, you can get 5% for savings accounts, term deposits in the safest environment they can be, which is in cash. If that's then going down to 4%, 3%, all of a sudden it's not keeping pace with inflation. And at that point in time, people look around and see where can they get those sort of returns that they need. And traditionally that would be in shares and in property. People
want to have their money make money for them. It's the idea of owning an asset. And if you want to get 4 or 5% on cash, you can do that quite rightly in a bank at the moment. But with those interest rates coming down, you're going to start to need to look elsewhere to get that 4 to 5%. Yes, you can get it through property, you can get it through shares, but that comes with some risks. The biggest risk that you'll have at the moment is that, you pointed out, you won't keep pace with inflation. So investors start to look elsewhere so they can continue to get that 4 to 5% cash on cash basis return. Now, Jared, I'm not sure if you've seen the stats, but in the US, there is currently $7 trillion, yes, trillion, it's a large number, sitting in money market funds or sitting in bank accounts, in savings accounts at the moment. It's at record highs. If those interest rates start to drop, there's a hell of a lot of money that can enter markets trying to look for that 4 to 5% that they can no longer get. Jesus Christ, not get.
There's a double benefit there. So you've got the lower discount rates and you've also got the fresh money that is flooding into markets.
Yep.
which is swelling inflation,
Swelling asset prices.
swelling asset prices and valuations.
Yep. So we've just gone through how lower rates can impact housing prices, but how they actually impact stocks or shares is that nearly exactly the same way. I'll give it to you with a little bit of an analogy of a lemonade stand, or you want to go and buy a business because the lemonade stand that you buy produces $10 worth of income. Next year, we hope it produces $11 worth of income. The year after, produces $12 worth of income. But what we've got to do is we've got to discount that back to today. Because if I've got that same $10 today and I sit it in a bank account and it earns 5% interest, well then next year, it'll be $10.50. So I want a larger return than what I would get for exposing myself to risk rather than sitting it in a bank account. When interest rates are dropping, that valuation now that company has got to make, or that the cash flow that company has got to make, my little lemonade stand, it doesn't have to make as much money for me for that to be attractive. So the discount rate drops. Therefore, asset prices usually get bid up. Same way that property does, shares work exactly the same way. When the cost of money comes down, valuations get supported or increase.
Was that bit a comment and little analogy about your lemonade stand?
I may or may not have had a lemonade stand when I was a kid, mate. Who knows? Take away the lemonade stand, the disparity that we've got in the wealth gap that has been created over these last 5 years, I've never seen it in my life, meaning that asset prices are continuing to increase, and that's largely been due to fiscal policy dominance. We haven't seen this level of spending from any governments around the world since, a wartime era, back in the 40s. They're still continuing to spend like that. We're now getting that coupled with monetary policy easing, or reserve banks around the world making the price of money cheaper. You've got a combination there of fiscal policy, which is still spending money or putting money into the economy, plus also the monetary policy easing, putting more money back into the economy, which is just going to drive asset prices through the roof. It's a little bit, we all get that feeling that we're a little bit sick for our kids and what's going to happen to the price of houses or the price of stocks, for our children. I still get that gut punch now talking about it and what's happening. And if you aren't on the right side of owning assets, now, Jared, you spoke about a general advice disclaimer. This is a general advice disclaimer. We haven't taken into account anybody's personal circumstances, but it just feels like asset prices are continuing to rise. And I can't see a scenario, unless something drastically changes, where that stops.
And even inflation, we talk about the number being at, between that 2 to 3% target range at the moment. It still doesn't feel like what your essential spend every week or every month is going up by 2 to 3% a year.
Mate, I'll tell you, the butter that I buy at Woolies was $5. It's now $9. That's not 3% price rise. That's nearly 100% price rise. It's ridiculous.
So there's gouging in certain areas, and it doesn't come back down at all. And this is where being strategic in decisions that you're making now and keeping pace with these markets is so super important for future you.
Don't even get me started on energy prices here in Australia. They aren't coming down. But Jared, what we're trying to highlight here for people is that when you've got monetary policy easing, especially from the big daddy in the world, it's going to light a match under asset prices, potentially. But you and I think it will.
Might be a bit of a butterfly effect in terms of how it is received around the world. We are going to see the Reserve Bank meeting approximately 2 weeks after this decision. And at the moment, priced in terms of rate cuts, about 16% in the current money markets. It'll be very interesting to see what that looks like in 2 weeks' time and then ahead of the November meeting.
Potentially more rate cuts here in Australia, and I think that they will follow the big daddy Fed in the next 6 to 12 months. So here's my challenge to you. If you don't own any assets, it's now the time to get serious, because the Fed has shown their hand with their playbook, and we're all about playbooks here. They'll choose asset owners over wage earners every day of the week.
This isn't an economic headline. This is a wealth transfer. And the question that we're asking here is, which side of that will you be on?
Thanks for tuning in to another episode of Your Wealth Playbook. If you could help us out in any way, the biggest benefit that Jared and I, and also Danny, will get is if you can subscribe to this podcast on your favorite platform and maybe share it. Send it to somebody that will benefit. You'll help us. If you'd like to help us, we'd love for you to help us.
The information in this podcast is general and does not consider your personal objectives, financial situation, or needs. Before making financial decisions, consider whether it is appropriate for you and seek professional advice. Past performance is not a reliable indicator of future results. If you would like to discuss today's topic further, reach out and we would love to help.
Jared and I have not assessed your individual circumstances. Therefore, this podcast is general in nature and for informational purposes only. This is not personal financial advice. There are so many advisors and brokers in Australia. You'll find one that you resonate with, but this is for informational purposes only. Or maybe just use Jared and I.